If you're planning to talk to your accountant about tax after June 30, I want to explain to you why that conversation is already too late. Tax planning, it's one of those terms that gets used a lot at this time of year, but most of what passes for tax planning isn't actually planning at all. It's counting up what's already happened. Real tax planning, the kind that actually reduces what you pay, has to happen before the year ends. So right now, with 2 months to go, you're still in a position to make decisions that matter. Once June 30 passes, those decisions are gone. I want to walk you through exactly what end of financial year tax planning actually looks like for a small or medium business. Not theory, practical steps that you can take right now. So let's start with the basics. Your tax bill is determined by one thing, your taxable income. That's your assessable income minus your allowable deductions. The lower your taxable income, the lower your tax. No taxable income, no tax. Tax planning, it's the process of legally reducing that number before the year closes. It's not about being clever. It's not about loopholes. It's about using the rules that already exist, timing your income, maximizing your deductions, and using the structures you're already operating in. And here's what's important to understand. You cannot go back and do this after June 30. The ATO doesn't give you a second window, and the conversation you need to have, well, that has to happen now. So let's have a look at the three main levers available to most small businesses. The first one, timing your income. If you have invoices that aren't due yet and you have some flexibility on when they go out, there's a case for pushing some of that income into the next financial year. Less income in this year means less tax to pay this year. Now, I'm not suggesting you delay payment from customers who are ready to pay, but if you have flexibility, it's worth looking at. Here we need to stop and remember that tax is not the only thing that we need to keep in mind. We want to get paid. We need the cash flow to keep funding our operations. So if we delay our invoicing, we're also going to delay getting paid. And that could be worse than having income and paying tax on it. The second one is accelerating your deductions. Now, the flip side of timing income is timing expenses. So business purchase you were planning to make anyway. So equipment, subscriptions, insurance, training. If you make them before June 30, that deduction lands in this financial year. Now, one important note, really important, don't spend money that you don't need to spend just to get a deduction. If your tax rate is 25 cents in the dollar, 25%, then spending $1,000 to save $250 in tax is a bad deal. It's a bad idea. Only bring forward expenses you were going to make anyway. The third thing, superannuation contributions. If you're a business owner, your personal superannuation contributions are one of the most powerful levers available to you. Concessional contributions, employer super plus any personal deductible contributions are taxed at 15% inside the fund, compared to your marginal rate outside of it. And the concessional cap, it's $30,000 this financial year. And if you haven't maximised that, you've got until 30 June to act. Again, a key point here is timing. The 30 June is the time that the superannuation fund must receive your contributions, not when you actually pay it. So it's got to be received and acknowledged by the super fund. Now, at this point, I want to mention the double tax trap. And this is something that I see catch a lot of business owners every single year, especially those who are returning to profit after a difficult period. Now, if your business made a loss or a low profit last year, your pay-as-you-go tax installments were set very low or even zero. Now, if your profit is back up, which means when you lodge this year's return, two things are going to happen at once. You're going to pay tax on this year's income. And then your installments for next year are recalculated upward because the ATO bases them on what you've just earned, your most recent tax return lodge. That's 2 lots of tax landing in a very short window, July, August, October. That's the double tax trap. And the only way to avoid being caught by surprise is to see it coming before June 30 and to set the cash aside for it now. Start planning for that cash flow. This is where careful cash flow planning comes in. You should, however, you should be looking at this on a regular basis, not just at year end when you're planning tax. All the time through the year, monitoring your cash flow. So why does the conversation have to happen now? And this is what I want you to take away from this conversation today. This is what I want you to take away. Tax planning isn't something your accountant does to you after the year ends. It's something you do together before June 30 to legally reduce what you owe and make sure you're ready for what comes next. The businesses that sail through end of financial year are the ones that saw it coming. They know their profit forecast, they know their tax estimate, they know what decisions to make and when. Now, it's not complicated, but it does require a conversation and that conversation has to happen now. Now, we've put together a free tax planning guide which can be downloaded through the link in the description below. It walks through exactly what to review before year end. And if you want to have that conversation with us directly, you can book a planning session through the link that you'll be sent when you access the tax planning guide. We work with small, medium business owners across Australia, and right now is exactly the right time to have this conversation.